Good afternoon, everyone. Thank you for joining us on this afternoon. So, I think we will begin. So, good afternoon, all, once again. Thank you for joining in. My name is Balaram. I am the managing partner of Spectrum Accounting and Spectrum Auditing. I'm a chartered accountant from India, and I have been working with various auditing firms like PwC, KPMG, and Deloitte before starting Spectrum. So, we started Spectrum in 2015, so it is about 8 years old company now, or firm now. So we provide accounting, audit, taxation, company formation, corporate taxation, and transfer pricing services. So along with me, I have Narendra, who is also a chartered accountant, and he has got wider experience on accounting, audit, and taxation related matters. So he also heads the CFO services team with Spectrum. So he is also one of the co-presenter along with me. So initial session, I will be handling it, and then second part or later part will be handled by Narendra. So the primary objective of this particular session is just to give a little bit more clarity in terms of the corporate tax related rules relating to books of accounts in particular. What all do we have to look at when we close the books of accounts for the year 2023 if your corporate taxation first tax period is going to be from 1st January 24, which is for most of the companies in UAE. So what all do you have to look at to close your books of accounts, and what do you have to keep focus more on when you close your books of accounts so that you're ready for next year for corporate tax regime or corporate tax period. So that is what is one of the key area that we want to focus on. And second thing is, of course, it is related also is about the transitional provisions. So what do you have to look at when you transit to the tax regime period? So this is the main focus. But initially, we will be just focusing on basics of corporate tax, just to understand what is what for about 6 slides or 7 slides. Afterwards, we'll get into the relevant areas of the law relating to books of accounts and then transition provisions. And then, of course, we'll have some time for question and answers. You can post your questions if you have anything in the chat window or chat box. We'll try to address them at the end of the session. So that being the background, so just to understand what is the legal form and what is the geographic form of UAE, because this is what is relevant for even corporate tax also, just to understand so that some of the rules are different for each of this. So UAE as a whole is a country divided into mainland free zone and offshore entities also we have. And of course, the free zones are again divided into free zone, financial free zones, and we have designated zones also, or designated free zones and other free zones. So financial free zones are generally the TAFC and ADGM, which are allowing or issuing the licenses to the companies to conduct financial related activities. And currently only 2 free zones, like I mentioned, DIFC and ADGM are providing those. And other category of free zones are designated free zones, which I have not mentioned here, but that is also relevant. Designated free zones are the zones which are identified as designated zones under VAT law. The same definition is applicable for corporate tax law also, like where you have customs authorities monitoring for goods and people getting in and getting out of the free zone, and which is a physically custom bounded area, so something like Zabza, Rakis, Umbria free zones. So those kind of free zones are designated free zones. There is a list of free zones which are called as, are considered as designated free zones. So that is what you have to consider. Other free zones are also there. So one thing here, there are many free zones that we know, but for corporate tax purpose, what is considered as free zone other than designated zone? That list is not released by the ministry yet. In the law, they mentioned that the free zones for corporate tax will be released by the ministry, but so far they have not released any list of corporate free zones considered for corporate taxes. So this one area we are not really sure whether all the free zones that are there are going to be considered as free zones for corporate tax or not. But so far we are still waiting for that list as such. So that being about the geographic form. Legal form, on right hand side you can see Some of the forms of the organizations are highlighted in dark blue. They are kind of licenses that we get, but they're not considered as separate from the owners. The entity and the owner together are considered as one entity, and the registration will happen in the name of the individual or the owner, like sole proprietorship, civil company, and so on. So all of them are, though they are licensed separately, but they are considered as one and same with the owner. So owner's name only will be registered, including the sole proprietorship or n number of sole proprietorship that particular individual owns. And then filing will be done in the name of the owner for all those sole proprietorships owned by them as a one taxable person. And on the right hand side, which are highlighted in red, they are independent entities and they are separate from the owners, like limited liability company, public joint company, and so on. So they will be subject to tax and registration will be done on their capacity independently. And whatever happens within the company is being held responsible for that company. So owners are completely independent from the companies for this category of licenses. So who all are considered as taxable persons and corporate tax under corporate tax law? So this is what it is. We have resident persons and non-resident persons. In resident persons, we have companies which are incorporated in UAE, which could be in mainland or in free zone. All of them are subject to tax. Here, even offshore entities are also generally considered as part of the licenses issued by free zone. So we assume that, we think that even offshore entities are expected to be registered and comply with corporate tax law by filing the returns. But that's what is the understanding so far. And companies incorporated outside UAE can also be considered as residents if those entities are controlled or managed from UAE. You have a owner of a foreign company who is sitting out in UAE and controlling that entire business outside UAE from UAE. Then the taxability will also be considered for UAE, and those foreign companies become residents or tax residents in UAE also, and they will be subject to tax and they are expected to register for corporate tax and then file the returns. And then we have natural persons who are generally not subject to tax, but if they are conducting any business in UAE, so those business related income will be subject to tax and they are also expected to register irrespective whether they have license or not. And we have the second category, non-residents. Non-residents are the entities which are registered outside UAE, which are foreign companies. But if at all, if they have any permanent establishment in UAE, which means if they have an employee of a foreign company who is coming here and then conducting business without having any license, or they have an agent who is habitually conducting or performing the business activity of that foreign company, or a branch or some other presence without having any license, then all those entities or operations are considered as permanent establishments, then they'll be subject to tax and they are expected to register and then subject to tax for UAE corporate taxes. The second thing is about having nexus in UAE, which is nothing but foreign companies or foreign nationals, if they have any who are not residents in UAE, or if they have any investments in real estate. So through that, they are considered as taxable persons in UAE. So they are expected to register and then file the returns as well. And third category of non-residents is that if any foreign company is deriving any source, a UAE source income, then they are also subject to tax. Of course, they are not expected to register for corporate tax, but they will be subject to tax in the form of withholding tax. For example, a company in India is supplying or providing some service to a company in UAE without having any direct presence here. So then the company in UAE who is taking the services from company in India is expected to do some withholding tax deduction. So in that manner, that Indian company is subject to tax in UAE. At the moment, the withholding tax is zero. So which means UAE company will not be deducting anything. But in future, if this withholding tax is increased to some percentage, more than 0%, maybe 5% or whatever, so then this UAE company is expected to deduct 5% of the transaction value and then pay the net amount to that Indian company. And this 5% what is deducted here by UAE company will be paid to the government in UAE in whatever form they mention. So this is how the foreign companies are subject to tax if they have UAE sourced income. So the tax rates that are currently prevailing are like, in general, the general rate is 0% tax up to the taxable income, which is taxable profit after adjustments, 375,000 dirhams. So up to 375,000 dirhams of profits after adjustments will be 0%, and profits in excess of 375,000 dirhams will be subject to tax at 9%. So all the mainland entities will be subject to tax at these rates. And qualifying present persons, they have different rates, which is 0% on their qualifying income and 9% on their non-qualifying income. But any free zone company which is not eligible for a qualifying present person, then they will be subject to tax in the regular rates of 0% up to 375,000 profit and 9% in excess of that. So if a free zone company, only if it is qualifying or becoming a qualifying present person, then only they'll get this 0% tax on their qualifying income, 9% tax on their non-qualifying income. So there are various other rules to be met to get this qualifying free zone status, which we are not focusing more on this. But yes, that's when you will be subject to tax at 0% and 9% account. So though the law became effective from 1st June 2023 onwards, but the applicability of corporate tax to the companies is connected or linked to their financial year. So any financial year beginning on or after 1st June 2023, the first financial year, the corporate tax will be applicable. So which means if you have a financial year beginning like 1st July to 30th June, then from 1st July 23 onwards for your company, the corporate tax will be applicable. But if your company's financial year is like January to December, which most of the entities will have are having. So for them, 1st January 24 onwards, the corporate tax will be applicable, which means the first corporate tax financial year for them will be 1st Jan 2024 to 31st December 2024, for which they have to file their returns and make the corporate tax payment within 9 months from the end of the financial year. That means before 30th September 2025, they have to file their returns and make the payment if your financial year is 1st January or January to December. So the table on the table you can see based on your financial year what will be the applicability. So most of the companies, they may think that their financial year is January to December, but they have to make sure that they are looking into their legal documents, and in those legal documents also they have mentioned the same financial year, whatever they are assuming as the financial year. If there's any different financial year mentioned on the document, you're expected to follow that, or at least go for an amendment and then make sure that both of them are in sync. So if that is not happening, then there could be issues later on whenever FTA or authorities will come to verification. So now let's get into the specific provisions relating to the books of accounts. We're not looking at other provisions of the corporate tax law. We are only focusing on those areas of the law which are relevant for most of the accountants and the financial finance team. So we are only looking at those provisions. So deductibles and non-deductibles are exempted income. So here in the exempted incomes, we have dividends, which other company, if it is investing in any domestic or local businesses, then whatever dividends you get is exempted. So the dividend income is not subject to tax at all. So this is what is given as exemption, and dividends that you receive from investments in foreign companies or outside UAE companies. So those dividends are exempted only if you are meeting the requirement or satisfying the condition of participating interest. So what is participating interest here is if your investment in outside UAE entity is minimum 5% or more of that particular company's shares, and you have the right to receive 5% or more amount of profits and the liquidation receipts, then only it is considered as having participating interest condition being met, in which case you'll get eligibility or your dividend income from that. Dividend income as well as capital gains are exempted. And if you have any other incomes coming from other domestic companies or local companies or outside UAE companies' investments, those are exempted only if you are meeting participating interest criteria. Again, the participating interest criteria is same like what I mentioned just a while ago. So other incomes could be a capital gain or capital losses, a foreign gain or losses, or impairment losses and all those things. So any gains are exempted if you are meeting these conditions. from investments in foreign or domestic companies. Income derived by a non-resident person from operating aircraft or ships in international transportation. So a foreign company is performing this activity within international transportation domain, and the respective company where this foreign company is registered, if that country also is giving the similar benefits to UAE companies which are operating in this, then in UAE, foreign company of that particular country, income is exempted. It is very specific to those particular industry and those companies. So income of a foreign permanent establishment, as I mentioned in my previous slide, a foreign permanent establishment, if it is effectively managed from here, then that is generally subject to tax in UAE also. It could be subject to tax in outside UAE as well as in UAE also. The only exception is that if you want to choose to completely exempt or not want to charge them or tax them in UAE, then what you have to do is that the revenues that you're getting from that particular permanent establishment, as well as the expenses also, you should not be considering them for taxation or for tax computation in UAE by including them here. So then only you can go for this option where the foreign permanent establishment will be completely kept outside of UAE tax regime. So then that will not be subject to tax in UAE. So these are the exempted income related rules. And we can now look at the expenses which are allowed to be deducted. So generally, some of the expenses are allowed, and we also see in the following slide that some of the expenses are not allowed. So to make sure that your expenses are allowed, generally you have to make sure that those expenses are incurred in a particular tax period, which means the cutoff is what you have to clearly see, and whether you also need to see whether those expenses that you are accounting in the current year, are they related to current year or not. If they're related to previous year or if they're related to the future years or future period, then you're not expected to include them in the current year. So it is very specific to the period, and you need to make sure that that cutoff and then timing is being considered properly for any expenses to include up to consider for deductions. And second thing is that you need to make sure that those expenses are incurred wholly and exclusively for business. So any expenses which are in personal nature or which are related to owners and directors' personal nature, those expenses are not expected to be allowed as deductions. So what if we have any expenditure which is incurred partly for business and partly for personal purpose? Then we need to take only that proportionate amount which is related to business and show that as deductible expenditure. The remaining portion is not allowed to be deducted. And next thing is that any expenditure that is in capital nature generally is not allowed to be shown as expense. But on the other hand, the capital items will be capitalized as asset, and you can show the depreciation related to those assets as an expense in the current year or in the years respectively. So which means you're not allowed to show capital expenditure as expenditure, but in the form of depreciation, you'll be showing or taking the benefit of the expenses related to them. And next thing is that any expenditure that you incur in connection to exempted incomes. Okay, we have seen in previous slides, some of the incomes are exempted. So any expenditure that you incur in connection to those exempted incomes or activities, then those expenses are not allowed to be deducted. It is very obvious. On one side, you are not considering the income to be taxed. So on the other hand, whatever expenses you incur in connection to that particular activity should not be allowed to be deducted. And any other expenditure that the ministry may come up later on, so that will not be allowed to be deducted or will be allowed to be deducted accordingly. So these are the expenses that are clearly mentioned as not allowed to be deducted in the law itself. So you need to make sure that these expenses are accounted separately, if at all, if you have other expenses related to the same category, so that at the end of the year, you are pretty clear that these expenses should not be considered for computation of corporate tax, and you are going to add back to your profit while computing the taxable income. Narendra will touch base on these topics or areas more in detail when we go to that particular section. But however, the expenses that are not allowed to be deducted are donations or grants or gifts that you contribute for any organization which is not part of qualifying public benefit entity. FTA or ministry has come up with a list of qualifying public benefit entities. So only when you donate money to those organizations, then it will be allowed to be deducted. Any other organization which is not part of this list, if you make any donations, then those donations are not allowed to be deducted. It could be anything, but it will not be allowed to be deducted from corporate tax point of view. And input value added tax, which is claimed as input tax credit, that is not allowed to be deducted. It is very obvious. And bribes or other illicit payments, very, very clear that you are not allowed to be deducted. Any commission that is paid to individuals, which is not a legal thing, that cannot be shown as expense and it is not allowed to be deducted. And next thing is that 50% of entertainment expenses incurred for or spent for shareholders, owners, customers, and suppliers. So all this, we will look into it in a future slide, but only 50% of it is allowed. What kind of expenses are considered as entertainment expenses, we'll see in the future slide. Interest expenditure, we have separate slide for that also. I'll look into that in that slide. And non-deductible penalties and fines. Generally, any fines that you pay, penalties that you pay for non-compliance of the law, that is not allowed to be deducted. But any penalty that you pay for breaching any commercial term or any commercial contract, so that penalty is allowed to be deducted. For example, you have a contract with your customer, and one of the term in that contract is that if you do not deliver the agreed thing in time, then you are subject to a penalty of 10,000 dirhams or 5% of the contract. That is something that you're paying as a penalty for not meeting the condition of a commercial contract. That is allowed to be deducted, but non-compliance of the law, if there's any penalty or fine, that is not allowed to be deducted for computation of corporate tax. So which means you have to account this category of transactions in a separate ledger. Dividends and profit distributions, it is very obvious that any profit that you divide or distribute as a dividend is not allowed to be deducted for computation of corporate tax. So dividends will be paid only after completing or complying with the corporate tax payment. Interest portion, as I mentioned, I'll talk in the future slide. Tax on income outside the state. If you have any foreign tax that you have paid on the income that you are including here, so the tax paid cannot be shown as expenses. However, you can get a foreign tax credit. After computing the tax, you may deduct that as foreign tax credit when you are eligible to do so. But foreign tax paid cannot be shown as expense. So these are the specific items that are mentioned in the law as non-deductibles. So as I mentioned, the interest, you can claim the interest portion as deduction, but there are certain limitations. So you can, as long as your interest expenditure, which is net, if you have interest expenditure and if you also have interest income, so interest expenditure minus interest income, the net amount that comes to is what we have to look at and see if that amount is less than 12 million dirhams or more. If that amount is less than 12 million dirhams, up to 12 million dirhams, it is allowed to be deducted without any limitation. But if that amount is more than 12 million dirhams, that's when you have to see only 30% of your EBITDA, which is earnings before interest, tax, depreciation, and amortization. Only up to that amount can be or is allowed to be deducted in the current year. Any excess amount of interest, excess of that particular percentage, cannot be allowed as deduction in the current year. However, you can carry forward for the future years and then adjust it there. And then also you will be following the same limitations. Is it below 12 million dirhams or more? And is it, if it is more, is it below 30% or more of EBITDA? And then accordingly you do it. You can carry forward it to 10 years in future. So that's what is the limitation for carry forward also. So what kind of interest components you can consider? I mentioned on the screen, so you can see whatever interest expenditure that you pay for business, all will be shown or can be shown as deductible interest expenditure, subject to meeting these limitations. One exception to this is that if you are taking any amount as loan from related parties, and those loans are specifically either directly or indirectly going to be used for this, either to pay the dividends or for profit distribution, or for redemption, repurchase, or reduction of share capital, or for capital contributions or acquisition of ownership interest in a legal entity. So if you're taking for any of these purposes, those loans from related party, interest paid on that cannot be shown as deductible expenditure. It is very obvious that you're trying to recirculate in the group and trying to show the expenditure, which you're not eligible for otherwise. So in these cases, you're not allowed to be showing take the deduction of the interest amount. As I mentioned, entertainment expenses, only 50% of the entertainment expenses can be deducted if they are incurred for this category of persons: customers, shareholders, suppliers, and business partners. Business partners, they have not clearly mentioned what is meant by that, or at least, the primary thing is only the customers and shareholders can be considered as business partners. So expenses incurred or entertainment expenses incurred for this category of people, only 50% of that can be allowed as deducted as long as they are connected to the business. So what kind of expenditure can be considered as entertainment expenses? Anything related to meals, accommodation, transportation, admission fees for any events, those kind of things can be considered as entertainment expenditure, and only 50% of them, that amount can be deducted if they are incurred for this category of people. Entertainment expenses incurred for employees is generally allowed to be deducted 100%. So for this purpose, you have to have clear bifurcation of the transactions and have separate account for each of this category of expense. You also need to be aware, like, if you have any transactions with related parties. Related parties are the entities which are part of the group, either owned by a holding company or owned by a common shareholder with 51% or more share capital with control, of course. So if that is what is meeting, then they are considered as related parties. And even since we do not have taxation on individual income, so there's a definition called connected persons also is given. So connected persons are those shareholders with 50% or more, or directors and officers who are at a responsible position in the company. Plus, these persons' relatives, all of them become connected persons. Any payments made to them by the company will also be looked at separately. For all these transactions, the transactions that are appearing in the screen, if you have any transactions with any of the related parties or connected persons, you need to make sure that those transactions are dealt with at arm's length. You need to comply with the transfer pricing requirements or regulations, and then have sufficient amount of documentation to demonstrate that they are at arm's length. So we have an exclusive team working on this transfer pricing, and we are also on corporate tax, of course. But yeah, transfer pricing is something that can be performed only by people who have got expertise in it. And we have been doing this service quite extensively. The team has been experienced in this for quite a long number of years. So you can definitely reach out to us for this. But this is the category of transactions you may or may not realize unless you clearly look into it, that you are doing some transactions with related parties, but you may not realize that those transactions should be dealt with at arm's length. So you need to make sure that by reviewing whether you have any of these kind of transactions, which you need to consider for transfer pricing compliances. And this is one of the important area. I touched base on in my previous slide, but any payments that are made by company to the owners or connected persons, as I mentioned, directors, owners, or key managerial person, and their relatives. So which could be in general, like, salaries, perquisites, rent, interest on loans, and so on. So any payments of this category paid to connected persons, we need to clearly make sure that they are at arm's length, they are at market rates. So we need to perform benchmarking analysis. It is very, not very clear or not very transparent transaction. We have to make sure that whatever payments we are making to them, in whichever form it is, to those connected persons by the companies, are they at market rate or not, is very, very important to look at, and we need to clearly have documentation. If you are to employ a third person to perform those services or activities, would you pay the same amount to that third party or not? So that is what is the general understanding or layman understanding of what is benchmarking of those transactions arrangements. So your closing balances should be cleaned, and then you have to get into the next year or with a clean 2024 with a clean reports or records. So that's what one of the important thing to look at. And one more important thing to look at is that if you have any payables or receivables from related parties in 2023, assuming that that is a last financial year of non-tax regime. So the closing balances should be updated as if those balances are already corrected or updated with arm's length or transparency requirements. So that's one of the important that we need area we need to look at. If you have any balances outstanding and the payable are received from related parties. Third thing is about anti-abusive rules. So generally we have a concept called general anti-abusive rules. Once the law came into effective, any changes to your business or structure of your organization or group, if you're making without having any commercial or valid commercial reason to it, but with an objective or sole objective of saving the reducing the corporate tax or avoiding the corporate tax. So those arrangements or changes to the structure are generally not allowed to be done. And if FTA or authority comes to know about them, whatever benefit that you are able to get out of that particular change will be removed and you'll be subject to tax on full as if you have not made that change. What would be the impact? So accordingly, you will be subject to tax. So any changes like, if you have business in mainland, if you are moving that to free zone, that's one thing I think you can consider. But if you have entities in UAE, in mainland as well as in free zone, so far you are routing your business through a mainland entity, but now you started routing those businesses from your free zone license or any kind of these changes that you're making with the sole objective of getting tax benefit, then that is something that you need to be careful. That is not allowed under this GAAR rule. But if you have any commercial or valid commercial reason, and based on that you're changing, if you're getting tax benefit under that change, then it is fine. But you should be in a position to demonstrate that you have a valid commercial reason to it. So this is another important transitional provision for the assets that are listed out here, like immovable properties, intangible assets, and financial assets and financial liabilities, significant portion of all your balance sheet items. For all of those items, this particular adjustment is applicable. And this will be relevant only at the time when you are selling those assets. So you have assets before your tax regime period, like you owned before your first tax period. And those assets and liabilities are being disposed after the tax is applicable for your company. So you have assets before first tax period, and those assets are being moved or continued to be used, and then later on you're selling them. So in those cases, this transitional rule should be applicable. The conditions are like, as I mentioned, so you should be owning those assets before the first tax period, and those assets should be held or shown or accounted at historical cost basis. And your selling those assets are deemed to be disposed after the first tax period, and that value is exceeding your net book value, which means you have a gain on that particular sale of the asset. Then it is very obvious to see whether the whole amount of gain will be subject to tax, or do you have any possibility to adjust this amount and then only consider that portion of the gain which is falling in this tax return period, right? So that is what we have to look at. So just to give you benefit, they have given these transitional provisions. So now let's quickly look at those provisions. There are two options that are given to you. One is about the net book value of value-based adjustment to your gain or loss. So what we do is that we compute the gain or loss, okay, by selling that particular asset. And from that gain or loss, we will arrive to the adjustment or adjustable value, and that will be removed, and the net amount will be subject to tax. Your total gain minus this adjustment value will give you the net gain or loss or net gain, which will be considered for taxation. That's what will happen. So now on this slide, we are looking at the adjustment value. How do we come to that adjustment value? They have given two options for that. So the option one is about this, based on your value, proportionate value that you look at. So what you need to do is that you need to arrive to the market value of your moved property as on the first date of your tax applicability, which means if your corporate tax to your company is applicable from 1st January onwards, then market value as on that 1st January 2024 is what you need to arrive to. From that, you reduce either of these two numbers, the original cost or net book value as on first day of tax period. So higher of this, so your market value as on the first date minus higher of these two items will be deducted. And that becomes your adjustment value, and then that you will be deducting from your total gain. So I tried to explain with an example here. Let's say that the market value is 100,000 dirhams on 1st January 2024, and your original cost was 60,000, and net book value on 1st January 24 was 30,000. So higher of these two numbers is 60,000, so which we will consider that. And market value was 100,000 minus 60,000 higher of those two items. So 40,000 is the adjustment value that will be come to. So this is what you will consider for deducting from gain. So that was option 1. Option 2 was based on the number of days you hold that particular property. So this is the second option that is given. So how do we come up to this adjustment value is, there are two elements to look at. So adjustment will be like, A into B. What is A? What is B? Is appearing on the screen. A is nothing but sale proceeds less higher of the original cost and net book value at the start of the tax period. And that will be multiplied by the multiplier, which is nothing but your divided by the number of days before first tax period by total number of days you hold that particular asset. How many number of days you held that particular property or asset before tax period, and divide that by total number of days that you held that particular asset. So this is the multiplier. So this multiplied by the A, which I mentioned above. So that will get you the adjustment value. I tried to come up with this example again here. Let's say your A component, which is a sale proceeds less higher of the original cost and book value. Let's say that is at 80,000 dirhams. And let's assume that you are the owner of that particular asset from 1st January 2023 till 1st April 2024. So if your first tax period is from 1st January 24 onwards, so before tax regime period, you are holding that particular property for 365 days. And the total period that you held was 457 days, which is nothing but 1st January 23 to 1st April 24. So you'll count to this multiplier like 365 days divided by 457. So this will be multiplied with that factor A, which is 80,000 dirhams. So you'll come to that 63,895. So this is what is the adjustment that you'll do from your gain. Okay, so this is second option. Anyways, we'll be sharing these slides with you just for your reference after the session, maybe tomorrow or day after tomorrow. But yeah, this is what are the options given for adjustment to your gain or loss for those assets which you held before corporate tax period and then still continue to hold and then sell later on. So just as part of transitional provisions, we have one more concept also, like it's not presented on this slide, but you have to categorize your assets into whether you want to consider them for on realization basis or accrual basis, and whatever adjustments that you do, that should be accordingly been shown. By default, you can go for realization basis, means whatever gain or loss that you make in between, which are not on realization basis, need not to be shown in the computation. It will be only on realization when it is really sold or disposed of. That's when whatever gain or loss will be shown. But you can also go for accrual method instead of waiting till the end of the disposal of that particular asset or liability. Whenever you have any changes in the value, that can be shown. So that is accrual method. That is also available. Yeah. So from here onwards, I'll hand it over to Narendra just to take it forward. He is going to discuss more about the year-end requirements for books of accounts.
Balram, and good afternoon all. Yeah, so key action points before the commencement of the first tax period. Yeah, so we are now entering almost into the financial year, the tax tax financial year, new tax financial year. But before that, we should have the previous tax financial year also. We need to take care certain points. What are those? Now let us see on this. So we must recognize the relevant items in the closing balance sheet of the previous year. What are those? As Mr. Balram explained in the previous slides, those are intangible assets, financial assets, and financial liabilities, immovable assets that we need to value according to the methods that he has given in the slides, the previous slides. The one is the valuation method and the time apportionment method, which we can elaborate in the coming sessions. And incorporation of year-end TP transitionally impacted balances. So what is TP transitionally impacted balances? So most of the cases, we have the related parties with us. So we do, say for example, we took some loans from the related parties wherein we didn't consider the interest, for example. Say for example, if we took 100,000 as a loan, we will most of the times we will show 100,000 as a balance. But there is a notional interest in it. So we must adjust that according to the TP closeness. That is the what the before period we should take care. Next, as the requirement of separate financials and carrying out of transactions. So the most tendency here, the owners of the companies will own the more than one companies in the most of the cases. In that case, the accountants or the persons who is handling accounts are most tentative to record all the transactions in a single books of account, which is the main entity. It should not be the case from now onwards. For that, even though our tax financial year will starting from 1st January 2024, it is needless to say that our 2023 balances should be aligned with the corporate tax. So we should separate the transactions in 2023 itself. If our financial tax is period is from 1st January 2024. Next, the most important, DTA and DTL. What is DTA and DTL? Deferred tax asset and deferred tax liability. As of now, we don't know what is allowed as per the books and what is not allowed as per the books. So till now we are going with the only one act, which is a commercial act. Now we have two acts, commercial act and corporate tax act. So one will say, okay, don't allow. One will say allow. So with that, DTA will be coming to the picture. Say for example, as Mr. Balram mentioned, certain expenses are not deductible in full. Certain expenses are not at all deductible. So when there is a conflict between the two acts, this DTA will come into the picture. And wherever there is an adjustment in any item, we must disclose it properly as per IFRS. Yes.
Yeah, just to add a point here, DTA and DTL for 2023 financial year ending, which is the closing of the previous tax before tax regime. We generally it is not applicable, or there is less reliance of DTA and DTL for your closing balance sheet of 2023. Only very few cases where you may be having some reserves or evaluation reserves or certain other reserves. That's where we need to look at it and see whether any deferred tax asset or deferred tax liability needs to be recognized in your opening balance sheet. Otherwise, generally it is not applicable. But yeah, going forward, you need to make sure that at the end of the year, once you are into tax regime, your deferred tax asset and deferred tax liabilities are properly computed and they are recognized in the books of accounts and financial statement disclosures are being compared properly. Yeah.
So what are the record keeping requirements before we are going to the tax financial year? Financials. It is needless to say, we must have the financials in our hand. And fixed asset register. So the most undervalued item is the fixed asset register. So most of the times we will pay less attention to the fixed asset register, but is very relevant for the having in order to substantiate our financials. The most favorable item for the owners is a fixed asset sometimes. So fixed asset register must be accurate. That we will discuss in the upcoming slides. The employees records as well. So we must have the proper KYC documents of our employees now. Inventory records. Since the most tentative item, inventory, which will impact directly the P&L and the balance sheet, we should have the proper inventory valuation. So we will value inventory with cost or material value, whichever is lower. And licenses. So it is as per AML provisions, we must have all the licenses to whom which we are dealing with. So sometimes the department may ask us we must have the KYC of our suppliers and our customers as well, and agreements on the contracts. You will say we most of the service organizations must have the proper agreements on their revenue contracts most of the times. And TP supporting documents. What is TP supporting documents? So, as we mentioned in the earlier slides, so related in order to substantiate that the transaction between the related parties must be in the arm's length basis, we must have the proper evidence. That is nothing but TP documentation. So, what is that action points? So we must identify our existing records. Where are we? And we must calculate all these things, additional records. And is there any amendments need to do for our current records that we need to see? And the most important item now, as of now, the government may not ask the VAT versus CT because of the insufficient information with the department. Once we file the first VAT return, then government will have all the information what we submitted as per the commercial corporate tax and what we have submitted information as per VAT. So there is 100% chances that they will cross check both and they will try to ask us the supporting if there is any mismatch. And we must train our team, the finance team and tax departments and tax teams and departments in-house, and we must update our SOPs as well. And most of the times, our current software may not be support for the corporate tax requirements. Sometimes the people may use this inventory modules. There are some ERP modules which may or may not support inventory because as inventory is the most common item. So we need to look at it. That is there any requirement for the ERPs? Changing ERP. Now we are done with the before. Now we will go with future. So what we need to do from now on? The first thing is the tax registration. Depending upon the financial year, we must do our registration most probably within 9 months from the end of the financial year. So we should understand what is our financial year by seeing our memorandum of association. If it is from January to December, our first financial year will be from January 24 to December 2024 within 9 months from the end of the financial year, which will be 30th September 2024. Based on that calculation, we must register on or before our first tax return. And tax return requirements. For that, tax return requirements means what? So how do we all are aware that 9% is the corporate tax rate. On what? On what? On the taxable profit. How to arrive at taxable profit? We must have the proper books of income in alignment with the corporate tax. So what are the return requirements that we need to see? At the same time, TP compliance that we have discussed earlier. The overall compliance regimes, not only this corporate tax, there are certain areas which we from other laws, say for example labor law, we must do our actuarial valuation in order to substantiate our gratuity provision. Those are also coming to the picture. So we must be ready with all these things before going to our first tax return. So we must assess our due dates as we discussed, and we need to assess our allowability, deductions, and what we are allowed, what are not allowed. And with respect to TP, if our turnover is more than 200 million, we must maintain the local file and master file, which right now we don't go deeper in this. We will discuss in the upcoming sessions. And country by country reporting filing requirements also. If our turnover is more than 3.15 billion, that is all about the transfer pricing. With regards to registration, yes, some still have the confusion. So do we need to register? We are in the free zone, so we don't need to pay any taxes. No, there is no such law as such. We need to, once you are a taxpayer, means once you are a company in a UAE, you must register without any question. All taxpayer will be required to register. To be registered before filing the first CT return. There is no registration threshold as such. And CT returns, unless VAT, which is a quarterly return or monthly return, and CT return is a yearly return, which is per year, to be filled within 9 months from the end of the tax period. As of now, there is no advanced tax provisions and all, but we may see in future. And it should be electronically registered through website of the FTA. As of now, the same website which will be allowing us to file VAT return as well as corporate tax. Now, the most awaited document, which is the computation. Till now, No one from UAE will see this computation, but now from 2024 onwards, most of the companies will be. This is the one of the most important document before the financial statements. I hope. So, what is the essence of it? So, accounting profit. So, as per the books of accounts, as per the regular books of accounts, what is the books profit? We must do the adjustments to it. So let's exempt income, as Mr. Balram mentioned in the previous slides, what are the exempt income like dividend and other incomes which are exempted, we must less. And expenses which are not allowed to be deducted. Donations, grants or gifts, the fines and penalties, bribes or other illicit payments, and dividends, and corporate tax for the it is important to know that corporate tax paid for our own company is not an allowed expenses. And input VAT incurred by a taxable person. So since we are getting benefit out of VAT input, we should not take it as an expenditure. If it is included in the book profit, we must deduct it. And tax income imposed on the taxable person outside the state, that we need to add. And any other deductions we must take into the consideration. And what is the adjustment? Other adjustments. If we are operating under tax group, we must adjust the intra-group transfers. We need not to calculate once again between the groups. And unrealized gains or losses, if any. So after all these adjustments, plus or minus, we must have the taxable income. On that, we need to, based on our location, if you are on the mainland or depending upon, as Mr. Balram mentioned, we need to reduce 375,000 and we need to calculate 9% over and over on the 370. If you are earning only non-qualifying income, being a qualifying prison person, then straight away 9%. That we need to discuss.
Here, I think what I was trying to explain is that you will consider the profit as per the books of accounts as the basis, and then try to arrive to the taxable income by making adjustments to it based on the allowability of expenses or non-allowability of expenses, taxability of incomes and non-taxability of incomes. So profit is considered and we make adjustments to it in order to arrive to the taxable profit or taxable income. Then you compute the tax on that. If you have any taxes to be adjusted out of that, if you paid any foreign tax, any withholding tax was paid, and that income was included in this computation, then that income the tax will be deducted, and you'll only pay the net amount as the tax payable amount.
Now, account record keeping. What is law mandates? How many years that we should keep our accounting records? As per corporate tax law, should be 8 years. 1 year current financial year plus 7 more years. And as per VAT law, it is for 5 years. And who should maintain all these records? All taxable persons and exempted persons without any question. And if our turnover is more than 50 million, for an audit. And in order to substantiate the qualifying free zone, to prove the capacity of qualifying free zone, they should maintain the accounting records, which should be audited. And penalty for non-compliance will come here, and 10,000 for each violation and 20,000 which is subsequent violation. These are all as per the corporate tax law. Yeah. So what are the documents that we need to maintain as per the particular act? So as per the corporate tax act, records related to business activities. Just to say that with balance sheet and PA, profit and loss account, and wages and salaries, we must maintain our pay sheet of our employees and our factory staff wages. And as I mentioned already, record of fixed assets. Fixed asset register is must and should. And inventory records. Inventory records, we didn't know that how many, what is the inventory is in sellable condition or not. We must provide the provisions on for that purpose, we must maintain the inventory records and the others based on the activity. And documents supporting entries in the books. So, what are the regular day-to-day transactions, invoices, agreements, as I mentioned in the previous slide, purchase, bills, all these should be maintained. And taxpayers record of elections, assessment, determination, and calculation related to the business. That's in the transitional provision, as we mentioned. We must elect our the basis of the balances we must elect before the commencement of the first tax financial year. So we must record what is our election, whether it is for a fair value or it's a cost. Like that, we need to maintain related party transaction records and subfunctions of records of fixed assets. And as per VAT law, tax invoices, licenses, and it is pretty all are aware that from 2015 onwards, tax invoices, licenses, contracts related to business, and calculations and workings for taxable VAT and related party transactions. Now, what are the methods of maintaining books of accounts? So there are two methods. One is cash basis and another is accrual basis. So cash basis means we just simply record based on the payments and receipts. That is a very conventional method which we may not know the true performance of our business. So it won't allow us to raise the accruals or I mean during the year ends. It won't allow us to make the provisions under. It will simply go when will be based on the payments and receipts basis. If you pay the payment, you need to record as an expense. If you receive the invoice amount, it will be recorded as interest. Unless, whereas in accrual system, we will based on the accrual basis, we will go whenever we raise the invoice, we will recognize as a revenue irrespective of the collection. That's why we will record as accounts receivable and accounts payable. But whereas in cash basis, there is no concept of accounts receivable and payable. But who will eligible for the cash based account? Entities which are having the turnover up to 3 million, they can elect cash based accounting, and in exceptional circumstances, they can apply for a cash basis accounting. And normally, as per UAE laws, what is the standards that we should use? It is normally IFRS. But if our turnover is up to 50 million, we can choose the SMEs IFRS, which is a short. I mean, it's not that much shorter form. Almost full form of IFRS is almost same as SMEs IFRS, but there are certain exemptions are there. The accounting standards, the local accounting standards are IFRS. We must use them. If our turnover is up to 50 million, we can go for the SMEs IFRS. And final statement of a tax group. We must prepare consolidated financials if we are in group entities. Preparation of standalone financial statements is must for each subsidiary. Consolidation of SFS and subsidiary with the parent, eliminating the transaction between them. Let us go for chart of accounts. So, what is the importance of chart of accounts? So, we are all are aware that we must record the transaction in a particular item. So, if it is expense, we should not record it as an asset, or if it is income, we should not record it as a liability. So, there is a relevance for this chart of accounts. But why? From now onwards, what we need to make a small changes to our chart of accounts. So since some of the expenses are allowed in as per books of accounts, but not allowed as per the corporate tax law, in order to ease our life while filing the corporate tax return, it is better to have a bifurcation at the first point. So fines of penalty is non-deductible and fines of penalty is deductible. We can make a different ledgers now itself. It will be ease our return filing process. Similarly, entertainment expenses. For entertainments also, we have two things. One entertainment expenses is 50% allowed and another is fully allowed. For that also, we must have the separate ledgers and foreign tax credit. And other incomes. All other incomes may or may not be taxable. Dividend income is exempt. And donations, which are non-deductible, that for it's better to have a, let us take the list of all non-eligible items. So we need to maintain, even though the same ledger, we must maintain the two different ledgers in order to accommodate the proper funding of profit. And it is needless to say that each and every expenses must be supported with the proper evidence. Is invoice from the supplier, contracts, etc. And inventory counting and valuation. Why it is important, as we mentioned already. Without proper inventory valuation, the profits will not be accurate. If you simply change the inventory, then your entire shape of the financial will be changed. So that is very important to have the proper inventory valuation. Sometimes this most of the ERP systems may not capture the inventory properly. In that case, we must have an inventory audit. We must suggest that at the end of the each year. And it will allow the management to relook into the condition of the inventory. Same, even if it is a manufacturing entity, even they may also not aware that there is some obsolete inventory which is no more useful for them. In such case, we must provide the provision for the slow moving inventory. Next, fixed asset register maintenance. As we mentioned, maintaining the up-to-date fixed asset is also very important, because when we are saying, for example, in our financials, there is a fixed asset of PPE with 5 million. We must substantiate the evidence. Yes, there are real assets we must have without any doubt. Let us say if there are any obsolete fixed assets or some useless fixed assets are recorded in the books, we must dispose with the proper accounting standard. In order to allow that, we must have the fixed asset register up to date. Next, so what is the relevance of the year end? What is that do's and don'ts we should do during the closing the books of accounts for the particular financial year? It can be any year. We should review the books of accounts properly. We should do the ledger scrutiny. We should go for each and every ledger. Like, for example, our sundry, our data should not show the credit balance. If it is showing, we must have the proper reason. Maybe we must pay the advance to our, we get advance from our customers. It may be advance from customers. It can be a negative. In such case, we need to deal that separately. So we must have substantive evidence that why it is on the, generally sundry debtors is expected to be debit balance, why it is credit, we must demonstrate. Similarly for the creditors should have the credit balance, and if it is debit balance, it is questionable why it is. Like that, it is not only restricted for APs and ARs, accounts payables and accounts receivables. We must do the proper ledger scrutiny for each and every ledger without fail during the year end, which will recording of all the transactions till the year end without any fail till 31st December of the respective financial year. We must get all the expenses, all the invoices from our suppliers, and we must issue the invoices, and we need to close the books of accounts. If it is a manufacturing entity, we must get the clearance from our production team, whatever. So we must record all the transactions in full till the year end. Next, confirmation with the third parties. Yes, most of the times we will record our own invoices and our supplier will record his own invoices. Maybe both may be different. So it's better to have a third party confirmations, at least for a major balances. It will facilitate us to recheck our expenses. Maybe we may miss some purchase entry or we may miss some sale entry. So needless to say that bank statement. So one of the most important items is the bank reconciliation. So we must get the proper, we get the bank statement of the financial year, and we must reconcile at the year end. Not only the bank statement, if we have any fixed deposits, we must get the fixed deposit statements, which will have the interest. We may not know because it is not a regular transaction. No, we may not look into it. We don't call the banker what is my interest as on it, like that. No, so we must get the balances as of the year end and recording of non-cash expenses. So normally we will book expenses whenever we pay, but there are certain non-cash expenses which is other than depreciation and amortization. We must, if you maintain proper fixed asset register, you can easily calculate the depreciation and recording of provision entries. So what is provisions? So as per certain other laws and regulations, so as I mentioned, actuarial valuation, we must provide a certain liability, because we must anticipate our future liabilities, right? So if our employee is leaving our organization, we must give him the gratuity, for example. So we must know before he is leaving, we should know what is our gratuity liability at the end. Those kind of provisional entries we should pass in our books of accounts. And accruals and different. What is accruals? So sometimes we may not, we earn that revenue, but we may not receive it. And we expend it, for example, most of the cases, rent or electricity bill, it may will give you a better clarification. You may not receive your Seva bill or respective Seva bill by the 31st of the financial, but you know that you consume some electricity. In that case, you must book the expenses. That is called accruals and deferred transactions. Sometimes you may receive advance from your customers for the future service provision. In that case, you earned that money, but it is not accrued to you. Say for example, if you are doing some service business, rental service or some kind of, some of your customer took the contract from you for the 2 years straight away, right from the January 24 to December 2026. He may deposit all the money right now. In that case, you are not allowed to recognize as a revenue. We should defer that revenue. So there are so many these kind of adjustments or transactions with respect to the year-end closure that we must do before entering into the new financial year, which will facilitate the auditors. It will ease our life without any hassle. So that is the relevance of the year-end closure.
Yeah, so I think this brings us to the end of our session. But of course, I think there are certain question and answers that we see. And before we get into question and answers, if you have any other question, or if you require any other services out of the services I mentioned earlier, you can reach out to us, and you can message your mail ID if you want us to share the presentation and then video for your future references. You can also look at our YouTube channel where we generally post our various videos also. But these are the contact details. As I mentioned, we provide audit, accounting, value-added tax, corporate taxation, transfer pricing, and company formation services. So you can reach out to us through any of these modes. Yeah, so this is what we wanted to share. We look at the questions that we have on the chat box. Just stopping the sharing. So I see that last question mentioned as, if you make any sales commission payment to third parties without any invoice, is it allowed to be deducted? I think it is. Yeah, some of the companies, they have practice of paying the commissions to people who refer the business. If you do not have any supporting document or a valid invoice, then that expenditure cannot be shown as deductible expenditure for corporate tax. So that is something that I think we need to be clearly, looking at, and what is allowed and what is not allowed to be deducted. Only with valid invoice that we are allowed to be deducted from for corporate tax purpose. So that's one question that we've seen.
Mr. Balram, if we receive a receipt voucher from the concerned person who takes money, consultant fee, so is it a valid supporting evidence or not?
I don't think so that receipt voucher is a valid supporting document. So I just give you a background, like in UAE particularly, we have generally any commercial activity that any person performs, you're expected to take a license from the respective authority and then perform the commercial activity. So if you are not able to get invoice from that particular person, which means he is not having a license or a approved license, but he is conducting that commercial activity, which is not a legal activity, correct? So any payments made to those kind of individuals, though you may have the receipt voucher, but I think it is not something that it is allowed to be deducted.
So will it be treated as a bribe or something? I think, will it be treated as a bribe or?
It's not legal. It's not legal. That's not, yeah, okay. It's not legal.
Okay, thank you.
Yeah, so the other questions what we have on the chart is, as per our VAT registration, financial year is March to February, but we are following financial year, which is January to December. Is there any amendment is required? So as I mentioned, for corporate tax purpose, we need to look at the legal documents or incorporation documents to see what is the financial year applicable for us. The VAT financial year is not linked or no connection to your financial year as such. So VAT financial year has no connection to your corporate tax financial year. Corporate tax financial year should always be linked to your incorporation documents or your legal documents of the company. So you could have a different financial year for VAT and different financial year for corporate tax. CET financial year should be based on your legal documents. So another question that we have seen is that if the company's legal form is civil company and contains more than 2 partners, is it required to register each partner separately for CET? I think it is, yes, you have to register separately, unless you want to register civil company as a whole or unincorporated partnership, for which you have to apply to FTA, permitting you to register that as one entity and one taxable person, and then be subject to tax accordingly. Generally, yes, it is each individual who has to register and then separate or divide the revenue and expenses and then come up with the taxable amount accordingly. So another question that we see is the CT treatment on the following items: provision for slow-moving stock, allowances for expected credit losses, bad debt written off, and then provision for gratuity. I think this is what I was just trying to mention. You are given a choice to go with the realization method or accrual method for certain assets and liabilities, depending upon the election that you make. So whether these will be allowed or not will be decided. So if you are going for accrual method, then all these will be allowed to be deducted. Of course, you need to have the proper supporting and calculations and all those things to have these provisions and then ECL and all those things. But if you are following the accrual method and if you are elected for those things, then yes, you can show them as deductions. So slow moving item provision also is same, like we have seen. So I think there's one more question about the movable assets being valued. The valuation and the options that we discussed are given only for immovable properties or assets, and only those category of assets and liabilities. So others, I think we do not have any option but to go for competition. And moreover, we need to look at that these transitional provisions are given only for those assets which you own before the end of the year, before the tax raising period, and which you continue to hold afterwards and then sell later on. So if there's any goodwill in the books of accounts for a business combination prior to first year of transition, will there be any DTA impact on this? I think this is something that may have impact. We may have to look at this. Something it is similar to your revaluation reserves, which could impact your future profit and loss, and then accordingly the tax. I think we need to look at that and make sure that the goodwill is updated and valued properly when you get into your first tax period. A DTA impact, I'm not really sure whether that will have any DTA impact. This is something that you need to look at clearly.
Mr. Varma, one question. What is the treatment of bad debts?
Yeah, bad debts, as I mentioned. Yeah. So generally it is allowed to be deducted whenever it has become bad. If you are following the accrual method. Even for corporate tax purpose also, for the assets and liabilities, you are expected to elect which method you want to follow. That is not presented in the presentation as such, but yes, there are certain rules that have been given as part of transitional provisions. So in first tax return, you have to elect which category of assets you want to go with accrual and which you want to go with the realization basis. So if you are going for accrual method, bad debts will definitely be allowed as deductible expenses. And you may have some of the bad debts which you provided realized later, then of course that will be subject to tax whenever you realize them. So the real estate property related income, generally if you are investing into those real estate income based on your out of your own individual capacity and out of your individual's savings, then generally in the hands of the individual, it is not subject to tax. And if you have sole establishment and the properties are owned in your individual name, then I think similar rules will be applicable. On the other hand, if you are individual owner and you are investing in too many properties, and you have a team of people who's taking care of those properties management and then renting them out or maintaining them and all those things, though you do not have license or you have sole proprietor license, since you are conducting this as a business, whether you have license or not have license, so this is going to be a business income and it will be subject to tax, though you're an individual. So for an individual, they have given a limit of 1 million dirhams if you have a business income, and up to 1 million dirhams, it is not subject to tax. If your income exceeds 1 million dirhams, then it will be subject to tax, and then you are expected to register in individual name and then comply with the requirements. So there's one more question. Amounts paid to overseas agents who are helping us to procure business from overseas customers. Is it deductible expenses? Further, if such agents are individuals and not any form of legal company and do not provide any invoices, will it still be deductible expense? I think the first part of it, if you get invoice and if that particular foreigner is providing out of based on the company, having outside. And if they provide proper documentation, it is clearly a service charge that you're paying, and it is for business. And since we have supporting document which is legally valid, it can be shown as expense. The problem comes only if this service is provided by an individual in this individual capacity, and that individual is not providing you any invoice or any supporting document, which I think is a question mark to which is in question. I don't think it is allowed to be deducted because it is not legally permissible activity. But if that respective country is okay, there are no any legal requirements for individuals to conduct these activities, maybe I think we need to look at that. But if we do not have any evidence or any document or supporting document which is valid, I think then it is not a deductible expenditure. So even we are also trying to understand how does it work if that individual is a foreigner and providing those services in individual capacity. So far, it was not looked at it so seriously, but I think now we need to look at it. It is always advisable to take these services from legal entities. So we'll just look at this last question. My employees book flight on Emirates for business trip. All the documentation is in his name with Emirates. Is the documents he provided for cost of the flight acceptable? I think if it is provided to the owners, customers, and suppliers, as we discussed, though it is related to business, it is only 50% that is allowed. I think the question here is that whether those invoices or the supporting documents, are they valid? Do they consider as valid the document or not? I think though the invoice is in the name of individual, but the ticket and all will be issued in the name of the person who is traveling. If that person is employee of the company, then it will be allowed as deduction. So there should be a connection between these two documents, invoice and then this ticket. They can be connected, then it will be a legal document to consider.
So, Mr. Balram, I have one question here. We have some old balances for AR and AP, and some of the old inventories also in our books. So, what do you suggest for the implementation of this CT?
Yeah, for
because
them, I
we
think
have these
thing,
balances from so many years, some account balances like ARAP and inventory also, and some of intercompany balances, receivable and payable we have. So what is the...
So I think you need to review all those balances. Since you're mentioning that they are old balances, you need to review them whether they are still recoverable, whether you have to still pay them, are they payable. Inventories, you need to look at them if you have any slow moving and non-moving items. The provisioning and then write-offs and write-backs, you need to make sure that they are done properly at the end of the year before getting into the tax period or tax regime period. And after making sure that these are being taken care properly in the tax regime period, as I mentioned, if you have elected them to be at accrual basis, then whatever provisions that you make in the tax regime periods, they'll be either deducted or added or taxed accordingly.
Okay, so it will be treated as income later on if you want to make any
based on your election, it will be based on your election, they want to go for it, so it will be subject to tax.
Okay, so in the return also we should give the detailed here what are the for example for debtors we have to give the full details of the debtors list in the return, or we are going to give only the lump sum amount while filing the returns.
So far they have not given the form or template for the CT return filing, but I don't think they will ask you to provide the details of by party or whatever. So whatever, I think they may ask you to give the details of the adjustments that you make, if at all, if they want. Yeah, so I think if you have any more questions, you can drop in or you can send us an email as I displayed our contact details. Since we have reached the time, once again, thank you all for joining us, and definitely we'll be happy to provide you any service that you want us to do. And thank you once again, and have a good day.